My name is Abel Montoya. I'm with the Illinois Student Assistance Commission. We're the state agency that awards grants and scholarships to students so they can go to college, because our mission statement is making college affordable and accessible for all Illinois students. And one of the elements that we use in regards to determining who gets financial aid or who gets what we call the Monetary Award Program, which is the state grant, is the free application federal student aid, the Fafsa. Now, you and other people like yourself will have a lot of questions about the financial aid process, and it's natural and it's expected you have questions. Hopefully today we'll get some of these questions answered for you, and more specifically we'll talk about the FAFSA, the free application federal student aid, and I'll show you some of the screenshots that you'll see when you go online, and we'll talk about some of the elements that may be germane to your specific situation. But before we get started, I want to talk about some basic concepts so we have an understanding of how this comes to play, how this works together. Financial aid is money that is, or refers to money that is either borrowed, given, or earned by the student or the family to help offset the cost of education. Because the student and the family, they're primarily responsible to pay for their education. So the student is primarily responsible to pay for his or her education. Then financial aid comes into play to kind of fill in that gap between what they can afford to pay and what it is to attend that university and college. The money comes in really two types: gift aid, money that is given, does not have to be repaid, and those would be your grants, which are typically based on financial need, and your scholarships, which are typically based on merit, academic achievement, extracurricular activities, whatever it may be. So those are the two basic gift aid type of financial aid. Then we have self-help aid, where something has to occur, either in terms of paying a loan back or a student has to work, and those two types would be the work study, that's specific type of job through the campus, or through loans. And with loans, I always tell people, proceed very carefully, because loans always have to be paid back. But a lot of this information is information that you already covered, at least should have been covered last year. Now, this money comes from 4 different sources: the federal government, which is like the Department of Education, which is the largest source of financial aid in the country; then the state government, which would be our agency; the college itself, so the colleges to which students will be applying; and outside private sources, so like private scholarship foundations. So those are the 4 places from which the money will arise. So how do you get that money? Well, you fill out the free application federal student aid to be considered for the Department of Education funds and for the state of Illinois funds. Institutional forms may be required. Typically, it may be the application for admissions that will consider students for institutional monies, or they may ask you to fill out the CSS profile, which my colleague Paul will talk after I finish here. And then sometimes if you are applying for a private scholarship, they may have their own forms. But the free application federal student aid, the FAFSA, is the main form that is used by the state of Illinois and Department of Ed to consider students for financial aid. When do you file? You file after January 1st of the student's senior year, because they go back and look at the calendar year. So for students that are currently seniors, they'll apply after January 1st of 2013, and they'll look at the base year or the calendar year of 2012 in regards to the income and the assets of the student and the family. It should be done as early as you can after January 1st. Typically, I recommend getting it done in January or February, because money will run out at a certain point. You do not have to have your income taxes done at the time you fill out the FAFSA. You can submit a FAFSA with estimated information, or you can use your W-2s, or you can use the prior income tax forms, so basically income tax forms from 2011, to fill out the FAFSA. Once you've submitted, you kind of save your place in line. Because for the state of Illinois, the MAP money, we ran out this past year, March 26th. That was our suspension date. After March 26th, we didn't give out any more MAP money because we had a limited pool. Colleges will have their own deadlines too, so you can be considered for institutional funds. Colleges will say, get your FAFSA done, so we can see, we can make sure that we've exhausted all state and federal monies before we dip into our pockets and give you some of our institutional monies. Now, who should be applying? All high school seniors who are U.S. citizens, U.S. permanent residents, or eligible non-citizens. Okay, and this has to be done every single year. Okay, you need to apply every year, because the financial situation of family may change from one year to the next. You can submit a paper application. It's going to take a while to get it processed, but you can if you want to, but we really prefer that you do it online, all right? And the FAFSA is what's going to determine what is the amount or the number that the government thinks the student can contribute to his or her education. And this is what's used by the college to determine how we're going to package the award letter for this specific student. So what do you need? The student has to have a Social Security number, and we need to make sure it's correct. That's probably the biggest mistake people make, and that they transpose numbers, all right? And we had to make sure that the name that they put on the FAFSA is the name that's on their Social Security card, because the FAFSA information, they check the SSN with the Social Security Administration. If that does not match up, the FAFSA basically gets rejected, okay, or it stops. It doesn't get processed. So we need to make sure that question number 1, name, and then the Social Security number, that information is correct. We'll need records of income, such as income earned from work or for business, child support received or paid out, and any other untaxed income. Ideally, if you have W-2s or an income tax return, that would be ideal, all right? We'll also require, or the FAFSA will require, information on the assets, such as savings, CDs, stock options, bonds, 529 plans, or the educational plans, any investment in real estate, things like that. Because the FAFSA is going to take a picture of what is the financial strength of that family in regards to the income and then the assets for both the student and the parent. And that's important because in most cases, the student will be a dependent of the parents. A driver's license number, that's really only, but not only, but that's really to establish you're an Illinois resident. And if they're a U.S. permanent resident, that alien registration number. When I sit down with families, I tell them, create 2 piles, a student pile and a parent pile. You don't want to mix things up. It makes things a lot easier. And then keep these piles in a separate location where you know where you can get them if you need to reference any of those elements. When you apply online, you go to fafsa.gov, okay, .gov. It's not .com. .com is where you have to pay. What's the first word of FAFSA? Free. Free application for the student. It's free to apply. If you want to get a paper application, you can try to call the Department of Ed. They'll tell you, oh, we got a great website. Once you go to it, they're like, you say, I really want one. They're like, well, we still got a great website. Once you go to it. Actually, you can also print out a PDF. But the good thing about applying online, it's a lot of great little benefits to it. First of all, it's quick. Okay, you submit the information, you do electronic signature, and we'll get to that in a moment. It gets there right away. It's submitted right away, and then they just got to verify a few things before student gets back the student aid report. There's a skip logic associated with the FAFSA itself. So if you create or enter data where there are inconsistencies or they contradict each other, the form will bring that to your attention and say, hey, did you really mean to say that you make $50,000 and you paid $50,000 in income taxes? Or like, oh, oops, I meant $5,000. You know, so it eliminates mistakes. All right. And it can help expedite the processing of it. Because the other thing too is that with the skip logic, you may not have to answer all the questions on the form. The form itself, if you print out a paper form, has over 100 questions. With the skip logic, there'll be certain sections you won't even see, depending on how you answer a previous question. And then it's also safe. It's encrypted. You know, the information that you submit is confidential. It doesn't get shared with anyone else. The FAFSA does some checking with other departments to make sure certain elements are correct, but no data is shared with any other entity within the Department of Education. When you go to fafsa.gov, this is where you're going to see, all right? And where do you start? Well, right there in the middle, it says start here, all right? You click on there and you get to the screen where you indicate which FAFSA form you want to fill out. A student will always fill out the FAFSA form with the year that correlates to the time they will be in college. All right, not the time they're here right now, but the time they'll be in college. So come January 1st, 2013, your students will fill out the FAFSA for the 13-14 academic year. This is a screenshot that we have right now because the 13-14 FAFSA is not yet ready. It won't be ready till after January 1st. When the student fills out the FAFSA, that's going to be good for the fall of 2013, spring 2014, and summer 2014. So it's fall, spring, summer. So always keep that in mind. So when they click on the FAFSA, they need to make sure they click for the right academic year. That's another common mistake. People fill out the FAFSA for the wrong academic year. It's broken up into 7 sections. Student demographics, school selection, because the FAFSA is a federal form that's sent to the Department of Education. They calculate information as to the financial strength the strength of the family, send a summary to the students, but then they also send the same information to the different colleges so they can make up the award letter. So that's where the school selection comes into play. Dependency status, that's the section 3. That's where we assess whether student is dependent or independent. Then if needed, parental information. And then financial information of both the student and the parent if the student is a dependent. And then you have to sign and submit it, and then you get a confirmation. which basically would be like a summary of what was submitted. Now, what do you need and how do you get classified as a dependent or independent? Well, let's first of all, if a student is a dependent, we will need information on income and assets of both the students and the parents. If the student is declared an independent by Fafsa, not by you guys, by Fafsa, then we just need information on income and assets from the student and or spouse, or actually and spouse if there's a spouse, all right? But who's considered a parent? Well, the Fafsa is very, very specific about this. It says, if your parent is widowed or single, answer the questions about that parent. Very straightforward. That's the questions about whom you answer. If your parent is remarried as of today, answer the questions about that parent and your step-parent. If your parents are divorced or separated, answer the questions about the parent you lived with more during the past 12 months. If you did not live with one parent more than the other, give answers about the parent who provided more financial support during the past 12 months. Notice that it never asks who claimed you as a dependent on your income tax forms. That does not matter for determining whose parental information that you report on the Fafsa, okay? Now, what's going to happen is when you do the Fafsa online, certain questions are going to be pre-populated. You know, they're going to populate answers to the year you were born, are you married, are you working on your master's or graduate degree, based on previous questions. Because typically to be independent, you need to be over 24 years of age, you need to be married, a veteran, you need to be working on a professional degree, you need to have children that you are supporting more than 50% financially, you need to be in foster care, you need to have your parents, after the age of 13, you need to have your parents have been deceased, you need to be in legal guardianship. Very, very specific scenarios in which that dictate that student will be independent. Other than that, student will not be independent. And people say, well, what if I can't provide parental support? Well, this is directly from the Department of Education as to what they say. They say under very limited circumstances are students allowed to submit a FAFSA without parental information. These are the unacceptable, the not acceptable reasons to not provide parental information. Your parents do not want to provide their information. Just because your parents don't want to, that means it's not acceptable. Your parents refuse to contribute to your college expenses. Department of Education says we're sorry, but that's not acceptable. Your parents do not claim you as a dependent on their income taxes. Doesn't matter. They're still unacceptable reasons. The acceptable reasons for why a parent does not have to provide information would be if the parents are incarcerated, the student left home due to an abusive family environment, or the student does not know where their parents are and is unable to contact them. So you can see there's not much flexibility about that. If in most cases the student doesn't meet the criteria automatically being independent based on age or marital status or legal situation, we're going to require parental information. Now for the parents and the student, what are the investments and assets? What is it that they take into account? Well, for investments they include real estate, but not the home in which they live. All right, that's one key element that people need to understand. Now, it's different for the CSS, and my colleague will talk about that. Investments also include trust funds, UGMAs and accounts, money market funds, mutual funds, CDs, stocks, stock options, bonds, other securities, and installment and land sale contracts, including mortgages, commodities, basically any type of entity that gives some type of dividend or which you make money. Now, qualified educational benefits like a 529 plan or Coverdell savings plan, those count as assets, but they count in a very specific way. For example, if the student is a dependent of the parents, then those 529 plans, even though they may be in the student's name, will become a parental asset. And the reason that's important is because parental assets, the government expects that a lesser proportion of those assets will be used for the child's education versus a student asset. They expect more of a student asset to be counted towards the student's education versus a parental asset. So it benefits the student to have that 529 plan be a parental asset versus a student asset. Now, the investments that do not count would be the home in which a family lives, life insurance policies, retirement plans such as a 401k, pension plans, annuities, non-education IRA, QL plans. So basically, the government doesn't count any of the stuff that you use for retirement because that's for you folks, so you can retire, all right? If you live on a farm, the family farm in which you live and operate does not count. And if you have a small business which has less than 100 or fewer than 100 full-time employees, That does not count as an asset. It's a way to protect the small business owner. Now, the one good thing about the Fafsa is that once you submit it, you can do estimated information. But then later on, after you do your income tax returns, you can do an IRS data retrieval, in which you basically, utilizing your Social Security number, your name, you get prompted to enter that information, and then it pulls the information you submitted to the IRS, and then you can decide to whether use that to populate the Fafsa or not to populate it. If you say yes, it will populate a bunch of different fields on the Fafsa. But once you do that, do not touch those fields. Because if you change those fields, then the information goes to the college saying, this was populated by the Irs Data Retrieval, but the family chose to change it, okay? Which means, okay, well, we want to know what's going on here, all right? This will be available after February 1st, 2013. Now, granted, not very few people fill out their taxes by that time because they're still waiting on W-2s or whatever reason. They usually wait a little longer. Now, who can use it? Well, you need to have filed a 2012 tax return. You need to have a valid Social Security number. You need to have a federal student aid PIN, which is basically like electronic signature. And you cannot have experienced a marital change since December 31st, 2012. Who should not use the Irs Data Retrieval? If you filed an amended federal tax return for 2012, or you did not file one, obviously you can't retrieve it if you didn't file one. And if your status for 2012 is married, filing separately. Okay, so those are the situations where you cannot use this. But it's a quick way to make sure the information gets updated properly, and the FAFSA gets processed quickly. When a student,
Sorry, I have to interrupt you because you said that FAFSA can be filled with prior year information, some guesswork. Would that work with IRS retrieval too? Or you can't change that?
no, you can submit a FAFSA with estimated information, and then later on, when you do your taxes, you can come back and use that to make the corrections or updates to the form itself. Okay? When you finish making all those entries and filling out the information, a student and the parent will need to sign the form. Okay? And this is what the signature page looks like. And you can sign electronically if you want, which is the quickest way, or you can print out a signature page and then mail it in. But I encourage you to do it electronically. You also have to agree to the terms, basically saying everything I submitted here is true, it's accurate. I would only use this for educational purposes, the money that I will get. And the same thing occurs for the parent. Now, the PIN is an electronic signature for the student and an electronic signature for the parent. Each individual will have their own PIN. It's just like a signature. It's a 4-digit number. It's conditional until the information, the name and Social Security number, is matched with the Social Security Administration to make sure that name and that SSN match. And then the FAFSA, then that PIN is permanent and it does not expire at the end of the year. For parents that have multiple children in college, you can use the same PIN to sign multiple FAFSAs. A FAFSA has to be submitted for each student that is attending college. Only one parent needs to sign it. All we require is the signature of one parent, okay? Now, if for some reason a parent chooses to sign the signature page because they can't get a PIN because they may not have an SSN, this is what it would look like. And you notice on the top there's a barcode, and that's how they use it to match it up, and you just sign it with the wet signature, and then on the bottom it tells you where to mail that signature page, okay? When you do that, the student will get a confirmation page that shows information about the colleges they selected, which include such things as retention rates, graduation rates. They will also get information about what their expected family contribution is going to be approximately, an estimate of what kind of Pell money they would qualify to receive, and an indication for student loan eligibility, all right? And there will also be links to the colleges they've indicated through what's called College Navigator, which has a lot more specific information about the colleges to which they're sending the students information. When this is done and everything's verified, the SSNs are corroborated and everything's correct, the student's going to get what's called a student aid report, okay? And that's the summary of the information students submitted, and they just need to review to make sure everything's correct. The colleges are going to get the same data but in a different type of presentation, different type of format. It's called the Institutional Student Information Record. They call it an ISR. And this goes to each college, and it has the same data elements that's in the SAR, except it has a lot of different flags and codes that the colleges use. And then the colleges use that information to come up with the award letter. When can you expect this SAR? Well, if you do everything on the web, and the family and student supply an email, so they can get an email link to the SAR, they can get, and they sign with a PIN, they can get this within 3 to 5 days. Okay, so it's really, really quick. But if they don't provide an email address and say they send a signature page, it's going to be 2 weeks. If they do a paper form, don't supply an email, there's going to be 3 weeks. Okay, so it's really quick turnaround time. Okay. And then if you do need to make corrections, if the data elements that are corrected do not need to be verified with another entity, everything is going to be immediate. Okay? But anytime you go into a form, into the FAFSA to make corrections or update, you have to re-sign it. So if you update student information, the student needs to re-sign. If you update parental information, the parent needs to re-sign. One of the mistakes, or not the mistakes, one of the issues that we see is that sometimes a student will go in, update information, and forget to sign it again. Then it's considered, that transaction is considered incomplete. So you got to make sure you sign that information. And then your award letter comes, for the student that is. That explains what they're going to get from the institution, and after my colleague is done, we'll go into the award letters in a little more detail. So really quick in summary, when you complete a FAFSA, the student is going to receive a student aid report. The colleges will receive an ISR. Now, sometimes the colleges will say, you know, we need to verify some information because there may be some inconsistencies, or they have a policy of having every single FAFSA verified. Currently, 1/3 of all FAFSAs are required by statute, by federal statute, that they need to be verified, which means they may ask for documentation, bank statements, or other information from the student and the parents to verify that the information that was submitted was accurate and correct. It's not that student did something wrong or illegal. There may be a mistake that needs to be corrected and they need to verify information, or they would just randomly select verification. The student needs to make sure that their verification process is complete, otherwise it will hold up their financial aid. Okay? So if they're select verification, they got to complete the verification. Then the student will receive their award letter from the college to which they've applied and been admitted. They review that. They need to decide, let the college know that they're coming, and then they need to complete any follow-up process or steps. Because once you go to a college, just because you applied for financial aid doesn't mean you're going to get it right away. There's some loan counseling that has to occur if the student is going to receive loans. If they are going to receive loans, they have to sign a master promissory note. So there's additional steps that may need to occur for the student to matriculate and get that money dispersed to his or her account. And then, of course, you have to meet with the college office to register for classes, do placement testing, et cetera, the typical steps with matriculating an institution. And then lastly, you need to renew this form every year because the situation of the family will change. Parents may make more or less money. They may have more children in the household. They may have more children in college. And one interesting thing about the FAFSA is that the older a parent gets, the more they protect of the income and the assets because they figure that they're closer to retirement, so they need to be saving more money towards retirement. So for all the young parents, that's awesome that you're young, but you'll be expected to contribute a little bit more to your child's education when they comes to the expected family contribution. And of course, if you ever have questions, you can always call us. You can call the state of Illinois. That's our number. With me, I have Christina Giosa. I'm sorry. She's one of our staff members who works out over here in the Naperville, Aurora area. So she's always available to meet with students one-on-one. I work in Deerfield, so I couldn't come out here. So she can work with students one-on-one in case there's any issues with the FAFSA. She can help streamline that. And obviously, your school personnel, your school counselors, they're phenomenal. They're more than able to help you. So there's a lot of resources for you. It's just a matter of getting in contact with them. And of course, you can always call the Department of Education. It's their forum. They have all the answers. Okay. With that being said, I'm going to turn over to my colleague. If it's one question, well, go ahead. All right, because we're going to take questions at the end, but I'll take a quick one right now.
Yeah, because I was taking some notes.
Sure.
In the case of divorced parents,
yeah.
Would, for instance, I have to put other parents' financial information in, or do they fill out separate?
If the parents are divorced, the parent with whom the student has lived the longest, the last 12 months, that's the parental information that we require. That's it. We don't require the other parent's information, okay? There is a question in the FAFSA that says, any other monies paid on your behalf? And that was kind of like a catch-all in case the other parent was giving the student money for whatever reason. But there's another question that asks about any child support or alimony paid or received. So that's a way to measure the money that's coming into the household and the money that's coming out of the household. When the Fafsa asks for the adjusted gross income of the family, that usually incorporates a lot of different things already. That's just one facet that's used. But then they say, okay, beyond the adjusted gross income, we know there's other sources of money, and there's other monies that are coming, either going out or that we're protecting. For example, if someone does work study, we don't expect a student to use that work study money for the following year. They need to be used for this current year. So we protect that money. If someone does a cooperative program, a co-op program where they take time off from college to go work, the money they earn is protected, so it's not expected that they save that for the following year. But if they work like at Wendy's or at the local bookstore, they're expected students to save some of that money for the following year. So that all is taken into account when they calculate the expected family contribution.
Just one more. What if the real estate loan is the parent's business in the case of like rental?
So what if the home is if the real estate is the real estate? Okay. All right. That's a great question. So that's a good segue to introduce my colleague here, Paul Daly, who's going to talk about CSS and a little bit more about those topics.
A lot of this, there is some overlap here, so if I run into that, I'm going to kind of just breeze over it. But my name is Paul Daly. I own OMH Partner Group, and I've been working with families for probably the last 15 years in the financial aid process and helping them through the financial aid process. And so I've been doing these types of seminars for quite a few years at a lot of different schools. And this slide here is probably why most people are in the room, right? College. And I'm a private company. I'm not part of ISAC or affiliated with the school in any way. But the cost of education is what's skyrocketing. So for a lot of families, when we're talking about the FAFSA and the profile and financial aid and scholarships, it's critical for a lot of families. Not a lot of families I meet with are able to just write a check for $60,000 a year to Northwestern. I mean, that's $250,000 over 4 years. So financial aid does play an important role for families, and I would encourage you to keep going to stuff like this. The more you know about this process and this system, the better off you're going to be. Let's talk a little bit about these two forms that Abel was talking predominantly about the FAFSA here earlier, and that is a free application for federal student aid. It is free to file, and there are some significant differences between the two forms. The FAFSA form does have to be filed for, again, as Abel had mentioned, all federal and state aid, and all colleges are going to require that form too. They're going to want to be listed on the form. I would highly recommend you do it electronically. It's a lot quicker, and I would agree. I would do it as soon after January 1st as you can. When I do them, I use estimated tax numbers because it's for the base year. So for seniors, we're looking at 2012 as your base year, and the assets are at a point in time when you sign and date the form. So if, let's say for example, and that's important, the timing on this is, let's say you're going to get a big bonus and it's a one-time shot, and you're going to get it in December. You can either take it in December of 2012 or January of 2013. Well, for tax purposes, you might want to take it in 2013. That's what most tax accountants would tell you because you want to defer the tax on it. But if it's a one-time deal, that might not go to your advantage if the base year you were in was 2013. Maybe you want to take it in 2012. So for seniors, I got a year ahead of myself. But you want to be looking at that base year. Sometimes there's some stuff you can do to plan within the base year. Again, assets are at a point in time when you sign and date and form, and we're going to talk about assets in a little bit here about what are they looking at, what are the differences in the assets that the forms look at, how do you evaluate assets, what's included as an asset, what's not included as an asset, so you have a pretty good idea by the end of the night of how all that works. It uses what's called federal methodology, which is basically a federal formula where a lot of these variables go into this formula, and at the end of it, out comes what they call your expected family contribution level. And the profile also has a formula, but they call that the institutional methodology. And the formulas are a little bit different. There are a lot of similarities, but there are some significant differences between the two. A CSS profile is available October of your senior year for the 2013-2014 school year if you're a senior. In fact, I've probably already done a bunch of them. This year it seemed we had quite a few people doing, some early admission, early decision stuff, and some of these schools, have an earlier deadline. So it's possible, you may want to check with your colleges to see if they want to profile early like that. Typically, we do them in January when we do the Fafsa. Okay, I usually do them at the same time under normal admissions procedures. We would just do them all in January, and same thing. We would do them on estimated tax numbers. The assets are at a point in time, so a lot of that logistics stuff is going to be pretty much the same. The CSS profile does charge per school, and there's also an admin fee. It's $9 for the admin fee, and I think it was $16 per school. So if you've got 10 schools that want a profile and you list them all in the profile, you have to provide payment of $160 plus the $9. So you'd have to give them a Visa or debit card or something for the for the cost of applying to those schools. If you had one school, it would be the $16 plus the $9. So that's one of the differences, is that there is a cost for the profile. One of the main reasons that a school wants a profile is, first of all, who wants the profile? It's typically your more competitive schools are going to want it. Your Harvard, your Yales, your Northwesterns, University of Chicago, kind of here in our backyard. And one of the reasons they want it is because it has a lot of other information on it that the FAFSA doesn't. So when the school gets the FAFSA form, it's going to see what your federal contribution level is. And they're going to use that for federal and state funds. And they're going to try to maximize those programs out as best they can. Before they dip into their own pockets, they want to see the information that's on the profile. That's why it's considered an institutional type of form. So that's one of the reasons that they want it. You can go to profileonline.collegeboard.com. There's no www there. And that is the College Board guys, are the same people that do the testing. You have to register for a profile, and there's a username and password that you'll need for that, and it's typically going to be the same username and password if your son and daughter already has a College Board account, which most of them probably do for the testing stuff. Okay, but if you don't, you can create it. I mean, it's not hard. You just create an account, register for it, and you can start that way. All right, so that's just kind of some general differences between them. So what we do then is this information goes into these forms, and it's going to go through these formulas. And at the end of the process, what comes out is a number, which is your expected family contribution level. That's what the colleges are going to use as a benchmark to determine what they feel you can afford to pay for college. All right, so. And I agree, the FAFSA's done, 15 years ago when we were doing paper FAFSAs all day long, I saw lots of mistakes happening when families were trying to do them. The logistics that they put into the software on the web, on the electronic side of it is actually really, really good. So you do catch a lot of those inconsistencies. So, filling out the form itself, and same with the profile, they also have some logic questions in there. And at the end, it'll say, hey, you skipped these 2 questions. You got to go back and fill them out before you can submit it. So the electronic versions do catch a lot of that. They've done a nice job with that on both forms. I think what's different, or what you need to understand, is that the information you put on that form is going to have a direct impact on what you're going to pay for college. And so where I kind of come into this whole picture is we look at that ahead of time. In other words, we're going to make sure that we don't have assets in areas that are creating problems, or maybe assets that are inflating this number when we don't necessarily have to. So there's different. It's kind of like tax planning. If you went to, if you go to you feel you're paying too much in taxes, maybe you go to a tax planner, and for some families, there's stuff they can do, work within the IRS, and reduce the tax liability. And same is true with this system. It's the Department of Education's rules, and there are sometimes some strategies that we can employ to try to reduce this contribution level. And that's certainly what you want to try to do. Demonstrating a need is this part of it's easy. You've got your actual college costs, and whatever the form comes back, your contribution level, and then the difference between the two is your need. And then the schools look at that and say, all right, how are we going to fill that need? And so that's when they start to work, that's when they start to come back with these packages. Just because you have a need does not guarantee you're going to get any financial aid. I know Abel will probably talk a little bit about that too. When you get award letters back, they can look very, very different. You could have 6 schools with the same need at all 6 schools and get 6 totally different answers. And I've seen that happen. So I'm going to go real quick through an example, and I won't steal all of Abel's thunder, I promise on this, but this is my favorite slide. I couldn't take it out. And a couple reasons. This isn't comparing award letters. This is just giving you an idea on how this might work. If you filled out a form, okay, and let's say your contribution level here was $20,000. You filled out the FAFSA, the profile, and it came back and said EFC of $20,000. Well, if you've got a state school of, let's say, 25, you'd have a need of 5. If you had an out-of-state state at, let's say, 40, your need would be 20. If you had a private up around 50, your need would be 30. And if you had an Ivy League at 60, your need would be 40. For the profile perspective, you're probably looking at these private Ivy Leagues. Not too many state schools want the profile. There are a couple, but not very many at all. And here's a part I think people don't maybe understand or get initially, is that if let's say all 4 of these schools met 100% of the need, well, what would your contribution level be? 20, right? It doesn't change. And now let's say that the Ivy League school, they want the profile, we send it in, and they come back and they meet 100% of the need, which, by the way, their track record is pretty good. It's pretty close to that. All right? Let's say they meet 100% of the need. And let's say the state school down here didn't meet 100% of the need, which is also potentially true because they don't have a lot of their own funds. They've got to rely on most of the federal and state money. Well, if that were the case, what school would you actually pay less, what would cost you less? Right? The Ivy, the one that's $60,000. Okay, and you could, this does happen. Now, obviously, it depends. If you fill out a profile and a FAFSA and your EFC is $60,000 a year and there's nothing we can do about it, well then, obviously, these schools with the lower price tag are going to cost you less money. But if you fill out a FAFSA and a profile and your EFC is 10, 15, 20, 25, 30, well then it might actually work out where these small, private, expensive Ivy League type schools may actually be similar in cost and in some cases may even be less. Okay, so it's possible. It is, and I've seen it happen. I have. It works that way. I'm not going to spend a lot of time on this. Abel did a great job kind of going through the aid sources, but basically the hierarchy on how a school goes through it. When you demonstrate a need at a school, the first place they look to is federal funds. And then once those are exhausted, the next place they'll look at is state money, which for our state is the MAP award, the Monetary Assistance Program. I would highly encourage you to do these early because I had clients that came in later and missed that MAP deadline and were eligible for MAP awards and did not receive it because they did this stuff too late. Well, they came in a little bit late. So you do want to watch deadlines. And then the last layer they go down to is their own pockets. And again, sometimes if you've got a significant need at a school, sometimes these private schools will be able to meet that need a little bit better than maybe the state ones can. This is an award letter. I'm just going to skip this for now. It just gives you an example of how they can be different. I know Abel's going to cover a lot of that later, so we'll skip over that one. So kind of what I talked about before, if you really understand how this works in the process and what are they looking at? When if somebody says report your assets on the form, most people think of their 401k as an asset. Well, as Abel talked about before, for FAFSA, it's not considered an asset. And maybe in the last 5 to 10 years, you don't consider it an asset either. It's very possible. The other side of my business, I do investment retirement planning, so I get to see both sides of this thing. It's been a rough 10 years, to say the least. So, but in some cases, how the Department of Education, what they define, their definitions of stuff sometimes doesn't match up with what your definitions of things are. So I would encourage you to really make sure you understand what they're asking for so that you don't inadvertently include stuff on there that you shouldn't. So you do need to understand this stuff. All right, let's talk about how these forms handle assets and incomes and some of the differences between them. As Abel talked about, we've got 2 sides of the formula here. We've got student assets and income, and we've got parental assets and income. And on the student side, it's from an asset perspective, it's the highest assessed area on the formula for both formulas. For Fafsa, they assess it at 20% of $1, and for CSS Profile, they assess it at 25% of $1. So what does that mean in, what does that mean in the real world? Well, let's say I've got $20,000 saved for college, and it's in my daughter's name. And you've got $20,000 saved for college, and it's in one of the parents' name. And we're identical. Same size of family, same age as parents, same income, same taxes paid, Social Security tax paid, age of oldest parent, everything is equal. All right? My contribution level, my EFC for FAFSA would be $4,000 higher because I've got it in the student's name. So let's say, for example, I had a need, let's say the school cost $60,000 and my EFC was $24,000 and your EFC was $20,000 and that school typically meets 100% of the aid. I've pretty much, right, I'm getting $4,000 less per year at that college. And if I've got 2 or 3 kids, that's potentially per student. So this area can add up very, very quickly. The multiplier in the profile is just a little, it's 25%, you can do the math. When they talk about income, it's about 50% of earned income over about $1,700, $1,800. Some of the profile schools will just put a $1,500 amount on the student side from income because they figure they can work in the summer and make some cash towards, generate some income towards this, which I think is, I think that's reasonable considering you're looking at a huge chunk of change. The income and the dividends, all right, the unearned income of what that asset makes is assessed at 50% of $1. So if you had a $20,000 asset, you'd be assessed $20,000 or 20%, 25% on the asset, and you'd be assessed 50% on whatever it made. Okay, so it's kind of a double barrel there. So when they bring these two together, what happens at the bottom is they come up with what's called a student EFC. So that's the student contribution level. What is a student asset? A lot of the ones that Abel just read. Okay, CDs, money markets, stocks, bonds, if they're in an UTMA or UTMA account. UGMA or UTMA account. So if you've got, Bob's, your son's name's Robert, and you've got a CD, and you're on there as custodian for the benefit of Robert. UGMA, UTMA, UGMA, UTMA. Some of you probably have those accounts. Those are considered student assets, and for both forms, they're student assets. And the operative word there is unified gift to minor and unified transfer to minor. Once that money's been gifted or transferred, it is technically no longer yours. You're on there as a custodian, and your fiduciary responsibility is to make sure that it's handled appropriately. You just don't go and spend it and take it and give it to someone else. All right. So if you've got UGMA or UTMA accounts, they might be in CDs, they might be in mutual funds, they might be in a lot of different things. There's certain assets that don't go on this form, either form, if they're set up right, and we'll talk about those. So that, maybe one planning area is if we've got student assets and they're creating a problem, maybe we need to reposition those into a different type of asset. We're not going to mess with the ownership, but we don't necessarily have to have the CD. All right, so that might be a planning area there. If it's not a huge amount of money, it's possible to maybe pay back parents for non-parental obligations. All right, parents love that one, okay? You don't have to pay for their car. You don't have to pay for their gas. You don't have to pay for their insurance. Those aren't, parental obligations. Housing, food, clothing, that type of stuff. You can't, go nuts and tell them they're paying you back $50,000 because you paid for their food for the last 12 months. That type of thing. So it's usually lower dollar amounts, $3,000, $4,000 maybe, something like that. They could certainly buy their own computers. They can certainly buy their own, if they're into music, their own instruments. They can pay for their own lessons. In other words, if student assets are creating a problem, instead of you paying for those types of activities, use their money for it. You can earmark the same money in your own account if you want. You're the parent, you do what you want with your own money. So if somebody needs to go out and buy a new guitar for $1,500 and wants to, they're taking some advanced lessons or something like that, you can use their funds for that. You could certainly earmark the same amount if you wanted. So, maybe spending down might be another option. All right. So that's just the way that both the forms handle the student assets and income. Parental assets and income, as Abel talked about, there's allowances. As you get older, the allowances go up. Sure.
I just have a question about
Sure.
student income.
Yep.
If a student has an investment like a trust fund,
Uh-huh.
from wherever, and that trust fund matures over a certain period of time, but it does create interest,
Uh-huh.
which gets put back in. Is that interest considered income for the student, even if they can't access it?
Great question. What about trusts? Trusts are not considered a protected asset, depending on what the trust is holding. If I'm guessing it's some sort of a mutual fund or maybe a dividend type of thing. Right. Yeah. The income from a trust could be considered unearned income,
Even if they can't access it?
even if they can't access it. Now that might be a letter of special circumstance. Almost kind of a phantom income type of thing or whatever. And we'll talk about that in a second. What to do with phantom, or what to do with phantom circumstances. What to do with special circumstances. But yeah, even if you don't have access to that, some of the trusts are restrictive. Yeah, and some of them, we've had to go back and have attorneys go in front of the court and judge and explain to them why we want to reposition stuff. And we've got to lay this stuff out for them so they understand, it's in those cases it wasn't in the child's best interest to leave that asset in the type of asset it was in. We still leave it in the trust. We don't mess with the ownership. It's the type of asset that the trust owns that we can sometimes change. So, a good question. Trust can be tricky. So, you get a bumper sticker. Trust can be tricky, right? Bad joke, I know. All right. Parental assets. Parental assets and income. Pretty much, it's a little under 6% of what both forms assess your parent assets after the allowance amount. And that allowance amount is based on age of oldest parent. So the older you get, the older the age of the oldest parent is, the larger that allowance amount is. So if your family, based on the age of oldest parent, if the allowance amount was $40,000 and you had a $35,000 CD, it doesn't matter. And that's for either form. It doesn't matter whether you had $1 or $40,000, right? If you had $50,000 and your allowance was $40,000, your EFC, your contribution level might go up $500-600. So, parental assets, most of the time don't create too much of a problem. If you are heavy in parental assets, then that's another issue we want to look at and say, okay, how bad is this hurting us, and what would we need to do to fix it? And then the bigger part of it is, what's the reality of this really having an impact? Because it doesn't do you any good to go out and change all this stuff if we've got schools that historically don't meet the need. I mean, what's the point of creating a need if they're not going to meet it? So we want to look at, okay, how bad is it affecting the EFC? What do we need to do to get it right? And what's an educated guess on what we think the impact's going to be? All right. Parental income, again, both forms are going to look at that. And both of them, again, have similar, they're a little different the way they assess it, but the idea, they're similar. The tables might be a little different on the allowances, but it could be anywhere from 0 to 47% once you go over the allowance amount. And when you look at the instructions for the federal and institutional methodology, I mean, there's like 90 pages of table data, and there's all these different allowances that come up to it. So that's where you could have two families with the same income and have two different EFCs, depending on the size of the family, age of the parent. They take what you pay in federal tax into account. There's a Social Security tax allowance amount. Do both parents work? Okay, there's a lot of different variables in that. So once you go over the allowance, then it's 0 to 47%. And it's like taxes. The higher you go over it, the closer you get to the 0, right? No. The closer you get to the 47, right? And so now they take these two areas and they bring them down, and we've got a parent EFC. So both of these together come out of the bottom as your expected family contribution level. That make sense? Okay. All right, let's talk a little bit about, and Abel hit on some of these. What's reportable on a FAFSA? What's not reportable? Reportable, checking accounts, savings accounts, money markets, stocks, bonds. They're talking about fair market value, both forms, at a point in time. So if you've got a government bond and its face value is $100 on January 2nd, 2013, and it hasn't matured yet, that's not the value of that asset. The value of that bond is if you cashed it in on January 2nd, what you'd get for it. And it may be less than 100 if it hasn't matured. So fair market value is a point in time of what it's worth. All right? It's not what, in that case, what the face value would have been. Mutual funds, individual stocks. Stock options can be a little tricky depending on if you've actually exercised them and taken control of them. Then they would be reportable. If it's just a stock option, who knows if they're really going to be there or not if you actually haven't taken them or exercised them. So there's a little bit of those can be tricky. Value of the business, if it's over 100 employees, is reportable. This changed about, I don't know, what, 4 or 5 years ago maybe? I don't remember, a couple years back. But we used to have to come up with the value of the business. So if you were you owned a plumbing, you're a plumber and you had a small plumbing business, you had a couple guys and some inventory and some trucks, we had to figure out what the fair market value of that was. Right? That can be a little difficult. So they changed that. If it's a value, if it's over 100 employees, then it's reportable. Value of the property, again, is not on there. Other than your primary residency. If you've got rental property in, Wisconsin, and it's a second home type of thing, well then, yeah, that's reportable. Now when we talk, sure. Great question. What do we put on for the value, right? How do we report that? Again, fair market value. So when the school, when on the FAFSA, they're going to want you to net that out. They're going to want you to take what the fair market value is minus what's owed on it, and the equity is what goes on that form. On the profile, they're going to ask you, what's it worth, when did you buy it, what do you owe on it, that type. They're going to get a little more specific, but they're still going to use the equity. Now, reporting the value on both of those forms, you want, again, fair market value, which is if you had to sell that property, not waiting 12 months for your top dollar, or you just put the deck on and it took you all summer, and they want, if there's a range, if it's between 300 and 400, you want to typically go with the reasonably low range. They're not telling you to make a number up, and they're not saying come up with some outrageously low number. Most people have a general feel of what their house might be worth, and it's just not the place to be overvaluing at that point. All right, does that help? How do you know your value? You could, you don't have to go out and get an appraisal or anything like that. You can maybe get a feel for what some of the other houses in the area sold that were similar, that sold relatively quickly. I don't, when a client comes in, I ask them, I go, okay, what do you think your house is worth? And they'll say 400,000. I say, okay, you sure? How'd you come up with that number? Well, it was appraised at that. Well, has anyone sold in your neighborhood for that? Well, Joe sold down the street at 380, but he had to wait 12 months to do it. Okay, well, if you had to sell it today, it's not really worth 380, is it? We kind of work through it like that. It's not, I wouldn't, you don't have to get too, sure.
The first question, if the property is used for rental income.
I'm going to get to that one.
It can't be disguised as a business?
That kind of goes along with your question. Yep, we'll get to that one. Sure. Same one?
What a business is.
Okay.
Take all of your checking accounts, savings accounts, mutual funds, and transfer them into corporations. Is that a business?
Let's just cover it now. If it's a value of the business, if it's under 100 employees, okay, the business and those business assets, you don't have to report any value there. Okay, so for example, if you've got this is where there's going to be a difference, though, between the profile and the Fafsa. For Fafsa, you do not have to report that. So let's say you've got rental property. Let's just, sake of argument, okay? And you and your wife own it, and you're the partnership, and you file it as a as a business return, corporate return. Well, that's your business is renting that property, and that business has under 100 employees. Therefore, it's not reportable on Fafsa. Okay, that sort of answers your question. For profile, they're going to ask you. They're going to ask you about, do you own a business? Do you there's going to be more questions about that, and most likely, most of those schools are going to want to know, okay, what's the business? What's it worth? They may require you to do a business supplement form. So for profile, it's not quite as cut and dry. Okay, but for FAFSA, yeah, in that scenario, it wouldn't be considered. You're going to want to, if you're not incorporated now and you're just using it as rental property, like a condos or something like that, I would go through this and see how much is it hurting me for financial aid, and then I would get the accountant involved and say, what is involved if we do have to incorporate this, and you'd start to have to gather, get both sides of that and figure out if it makes sense to incorporate or not, and how it impacts financial aid. So it's not necessarily a yes or no type of thing on that. Okay, good question, great questions. Farm, Abel talked about, don't live on it, it's not on the FAFSA. Non-reportable, okay, we talked about your primary house, not on the FAFSA. Cash value, value of IRAs, 401ks, or pensions, not on the FAFSA. Annuities, whether they are qualified retirement type of annuities or non-qualified annuities. Whether they're variable, whether they're indexed, whether they're fixed. Okay, they are non-reportable on FAFSA, and you can use those sometimes to reposition assets. Like the trust, for example. Instead of the trust owning mutual funds, maybe it makes sense for the trust to own annuities. Okay, we'd have to look and see if that makes sense. That might be one way it could become a non-reportable asset. Value of the business under 100 employees, not reportable on FAFSA, and if you happen to live on the farm, not FAFSA. For profile, okay, what do you think happens? I'll give you one guess. Okay, not all at once. A lot of them go back. Yeah, your house. They're going to ask you, when did you buy it, what did you pay for it, what do you owe on it, what's the mortgage payment? Again, fair market value, don't overestimate. And include all debt against it. First, second mortgages, home equity lines if they're outstanding. Okay, total debt against that property. Cash value of life insurance is typically not asked. The way the profile is set up is they've got a standard amount of questions on there, and then they have another section called supplemental questions. In the standard package of questions, there's nothing on there about cash value of life insurance. Every once in a while, what will happen is schools can subscribe to those supplemental questions if they want them, and there's about 2,500 of them or something. One of the supplemental questions is, what's the cash value of your life insurance? So yes, it's possible for a school to ask that, but it's not very common. I mean, every once in a while you'll see it pop up. Sure.
You're mentioning, make changes here, make changes there. But if our kids are going to be going to college in 2013 and we're making changes now, won't they question about these changes?
Good question. Timing on the changes, right? Should we do them now? Is it too late? It depends. It depends on what the assets are. Yeah, if you've got an asset that has a big gain in it, and all of a sudden when you go to send in a profile of FAFSA and you've got zero reportable assets but a $10,000 capital gain, they might say what produced that capital gain, and now you've got to disclose that to them. Some school, again, remember those supplemental questions? One of the questions on the supplemental is, do you no longer own any assets that have produced interest or dividends? I mean, they're pretty. The profile does a pretty good job of, pulling out a lot of the data that the FAFSA kind of misses. And again, the reason being is that's what they're using before they come up with their own money. So if you were doing, if I were doing this, I would want to know about the value of the home. I might want to know about some of these other things too. It doesn't necessarily mean you're going to be excluded from aid. It's just, it gives them a clearer picture of what's really going on there. So, Yeah, it could. It depends. It's very possible. We got to be careful. We got to make sure that, you know, A, we're doing it within the rules of the system, and then there's also the you know, if you moved assets, let's say, and you sheltered them from the form, and it's still at a capital gain, you haven't done anything wrong or illegal, but the school is going to look at that and say, okay, why is there a dividend, no corresponding asset? Logically, it's not going to make sense to them. And so they're going to say, okay, what happened? And now you've got to disclose the move, and they say, okay, fine, we get it, but now they know about, you know, whatever it is that we did.
401k, you want to know the total of 401k or just the CAS contribution?
Great question on the 401k. Let me get to that. I'm going to get to that one in a second, okay? But let me get everyone get a kind of a better picture on how this stuff works here with this. And just remember the fair market value is a big one because people overestimate this stuff. Sure. Uh-huh. I got a whole slide on 529s. We'll cover that too. Promise. Oh, good question. If you've submitted a CSS profile and you want to make a change, it's a little trickier. The FAFSA, you can go with. Let me just backtrack on the FAFSA for a second. You can't. Let's say you made a legitimate mistake on the FAFSA, and you can go back in and correct that mistake, all right? Or you did it on estimated tax numbers. You can go back in and then put the final numbers in through the, what do you call it, system? Yeah, the data retrieval system. So you can't, those are legitimate changes, or adding or changing schools. What you can't do with the FAFSA is say, okay, when I signed and dated the form, my CD was worth $50,000, and 3 weeks later I bought a car, and now my CD is worth $20,000. Okay, because that asset was at the point in time you signed and dated the form. So that would not be a legitimate reason to change. On profile, oh, and by the way, with the data retrieval system, I'd highly recommend doing that, because what happens is the schools will get a transcript. Basically, the IRS and the Department of Ed are talking. I don't know if that makes you feel good or bad, but that's what's happening, okay? And so when you do the data retrieval system, it actually pulls a transcript through to the colleges that they can use from the IRS stuff. So most of the time, you don't have to supply them with your actual tax reform form. Whereas before, you used to have to print out a bunch of copies and sign them and send them in. So it does streamline a little bit. Back to your question about the profile. The profile, you cannot go back in and make changes to it. You can go back in and update or change schools, but you can't go back in and change the data to it. So if you have a change with the profile, you need to contact the universities and say, look, we overvalued our house. It's really worth $350, not $450, and we made a mistake. Can you please take that into account and change it? So you don't want to overestimate that one to begin with. The profile also has their own version of a data retrieval system. They have what's called IDOC, which is kind of a central spine. And what you can do, some of the schools will require that you submit your tax returns to that spine, and then those schools will be able to access your tax data from there, and they'll go in and pull numbers out. Okay, so again, some of the minor differences. All right, let's move forward. 529s. Just so happened I had the slide next. 529s, I don't know if everyone's familiar with these or not. There's two types. You've got the 529 savings, and then you've got the prepaid tuition stuff, the Bright Start. If you've got prepaid tuition, you've already had them. In fact, at this point, if you got the 529 savings, you've probably had them for a few years. And the way they're reported, again, are fair market value. So if the 529 savings plan is basically a mutual fund. The state of Illinois uses Oppenheimer. I mean, you can use whatever state you want. And so it's whatever the value is of that 529 is what's reportable. The prepaid tuitions on the statements, you'll notice they'll have a value of what the prepaid tuition's worth. And a couple lines down, it'll say FAFSA, reportable FAFSA value or something like that. Okay? Which is going to be less than what the actual value is. Yeah, it is. Yep, it should be on the statement. And the reason it's less is that if you cash that prepaid tuition in, you don't get the full value of it. So they're again, a point in time. If you cash it in today, what would you get? So you want to report that FAFSA reported number on those. Where do they go? If you've got 10 children and you've got 10 529s and you're the owner, the parent, every single one of those 529s is going to go on your side of the formula. Okay? So any 529 the parent owns, for whether it's 1 or 10 kids, is going to be a parent asset.
I happen to have both.
Mm-hmm.
I distinctly remember on one of them, I don't remember which one, they said that it would count for FAFSA or whatever. I think it was the prepaid one.
They used to, yeah, they used to do these a couple different ways. It used to be where let's just stick with FAFSA for 1 second. Any 529 plan was considered a student asset. And at that point in time, they were assessed at 35% of $1. So that was not necessarily a great thing. Then what happened with the Department of Education is they went through a modification. They changed it. They said, okay, if the parent owns the 529, it's a parent asset. If it's a 529 UGMA or UTMA, like a student 529, then it's not reportable. So they changed it. And then a few years back, they changed it again, where now all 529s are parent assets. So I don't know. I mean, they're all reportable. Yeah. Yeah, even though it says for the benefit of, because that's not a custodian. If it says UGMA or UTMA on it, that's the student assets. But in this case, because it's a 529, any 529 whatsoever is a parent. Yeah. Even if it's owned by the child now. I know. I'm trying to get moving here. Let's stick around. How about we'll hit these afterwards? You know what? I'll be around afterwards too if you got specific questions. Okay. But bottom line is all 529 plans, whether it's parent student owns, are parent assets, and both forms deal with them the exact same. It does in the instructions, yeah. Yeah, it'll talk about that. All right, real quick here, and I'll try to wrap up. Retirement plans are not on are not on the FAFSA. However, the profile does ask with the value of your retirement accounts. It doesn't go through the formula per se, but the schools will look at that, say, okay, we got someone who's 45 with $1 million in a 401k and they can borrow against it versus someone who's 68 with 50,000 in an IRA. Okay, so they may make some subjective decisions on that. The income you contribute to a 401k gets added back on both forms. Okay, so you can't shelter income on either form by contributing more or less to your 401k. Either way, it's gonna show up. All right, how many family members? These are mine. It's a little bit old picture, but the FAFSA way it works and profile. If you've got one family member in college, your EFC is 20,000. It's 20,000. If you have 2 in school, it would be 10 for each student. All right, FAFSA is just going to ask you how many family members and how many are in school, and it's going to divide it out, and it's going to come up with the new EFC number. That could work to your advantage if you've got multiple kids in schools, and especially if you're at a college where they do pretty good with aid, because your need's going to be higher, right? Because your EFC is lower. Profile is going to ask you who is the other student, where are they going, what are you paying, are they getting tuition? Again, they're going to want to know more of the details about that. So they may not just do a flat across the board, cut it in half type of thing. Divorced, separated, married, talked a little bit about this. Yeah, just, I mean, I don't, real straight, it's who the student lives with more than 50% of the time. If you can't establish that, it's who provides the most support. If that person remarries a new spouse, that's FAFSA rules. Profile also has the same rules, with one exception, is that some of the colleges may require what's called a non-custodial profile, which is going to want to know pretty much the same information. It's like a profile for the non-custodial parent. And if that non-custodial parent's remarried their new spouse, it also goes on the form. Okay, so some of the profile schools may want to know both sides of what's going on there. So that's the major difference on that one. Not all of them, but if it's a profile school, it's possible they could ask that. All right, independent, dependent, we covered this. Both of them are pretty much the same. unless you've got a real extreme situation like Abel was talking about. I've actually had that. I had one where mom was deceased and dad was in jail, and I mean, we've seen some crazy stuff, and you know, but typically not too many high school seniors when you look at this list. Any of this stuff down here at the bottom line is it's got to be court. If you notice, it's all court appointed, court this, court that. You can't just go out and say, oh, my son or daughter is a man, you know, he's free now because we deemed it. It doesn't work that way. So it's pretty restrictive. Special circumstances, I'll hit this real quick. And I think that might, oops, go back one. If you've got trust, hey, we've got this trust that's producing 10 grand a year in income, but we can't touch it till we're 25. Yeah, that's a special circumstance because they're going to base your ability to pay on taking that $10,000 coming in. Or you had a job in 2012 and you made $100,000 and you get fired in, you know, December 31st. Well, you don't know if you're going to find a job and how much you're going to make, but they're going to base your ability to pay on the $100,000. That would be a special circumstance. High medical. Fafsa, there's nowhere to put medical. Profile, they ask you about your medical. Profile also with regards to the income is going to say, we want some numbers for seniors. We want some numbers off your 2011 return. We want what you think you're going to make or what you made in 2012. And we want what you think you're going to make in 2013. They're going to take 3 years. So if 2012 was a huge year and 2011 is more normal, I would estimate my 2013 like my 2011. All right, so profile will take some of those into account. If you get child support, typically ends at age 18. So if you got it for all of 2012 and you're only going to get it for 6 months in 2013, they're going to base your ability to pay for getting it for the 12 months. You need to tell them, hey, that child support of $18,000 a year or $15,000, whatever the number is, we're only getting half of that. Okay, that would be another special circumstance. Anything that has a negative impact on the income, where do they go? For FAFSA schools, if your school only wants a FAFSA, there's nowhere to put them. You got to write a letter directly to each college. Profile does have a section on there for special circumstances that you can add it to. I would still recommend that you contact each college directly and write them that letter. Say, hey, I've got special circumstances or medical, you know, or whatever they are. All right, and I ran long. What do I do? Real quick, I help families through this process. Yes, the financial aid is free to do. I technically don't charge for that. I'm charging for the consulting service. People want to come in. You know, I make sure that we go through all this stuff. We're not leaving. You know, we're going to look at assets and income. We're going to see how you are today. We're going to see if it makes sense to change anything, and then what type of impact that may have. And my fees, you've got there, and then the handouts, you got my card. And if anyone's interested, give me a call or email, and we'll, you know, figure out a time to meet. Okay, I'm really sorry I ran over. One
of the things that I think we need to also understand here is that the reason that so many questions are asked of individuals and families is because from the state and federal perspective, we want to award the most grant or need-based money to those that have the most need. Simple as that. So that's the guiding principle behind all the questions that are asked from the state and the federal perspective. And financial aid comes in many different forms, as has been discussed here and I'm sure in previous sessions. So let's talk a little bit about understanding and comparing the award letters, which the award letters can be a challenge. They're all very different. I've seen many of them, and even sometimes I get stumped by trying to understand what exactly is on there. The students will have two options, usually how to accept an offer of admission, typically online or via paper. But before you get to deciding where a student will attend, you need to compare and contrast one college offer to the other. And to do that, you need to understand what the colleges are considering. There's the cost of attendance, and the reason I put the slide up here is so to illustrate that not all the elements in the cost of attendance are fixed elements. Some will go up or down depending on how far away they go to college, if they go away to college. What would be the mode of transportation coming to and from the college itself or on college itself? The books and supplies, miscellaneous living expenses, those will all vary. So there is a little bit of flexibility. And the reason I mention that is that when you're looking at cost of attendance and you look at the award letter, you don't necessarily have to accept all the financial aid that's being offered. And when I say that, I'm referring to the loans that are given to you. You don't have to accept every single one of them because the cost of attendance in some cases may be a little bit more than what actually a student would need to spend at his or her college, depending on their lifestyle. Granted, some residence halls have quite a number of amenities, but usually those are the most expensive ones. They usually are cheaper residence halls. So you kind of you need to get a feel for what makes more sense for your situation. Paul mentioned this, the colleges, to determine financial need, they take the cost of attendance, take away the expected family contribution to come up with financial need, and the expected family contribution is that federal methodology to determine what is it that the family can afford to pay. So in this case, the AFC will always stay the same. It's just that financial need, that thing on the right. How do they comprise that? How do they break that down? What is it that's being offered to a family? You will get an award letter. When I say you, I'm talking to the student. The student will get an award letter, and all award letters will look different. This is one, the hypothetical one. We call it Pyramid University, just for argument's sake. And on there, you have to locate the cost of attendance. Here you can see it's kind of halfway down on the right-hand side in that little corner. And you need to look and see what exactly is being listed as the cost of attendance. You need to see if they're listing a specific set of hours or a specific term. When they talk about the actual awards themselves, they'll list the type of awards. So you need to understand what a grant is versus a scholarship versus a loan, and then what kind of loan. And they'll break them down by either quarters or semesters. So you can see how maybe a full MAP grant at a four-year university would be $4,720. They don't give you all $4,720 up front. They'll break that up into 2 semesters or 3 quarters, depending on the institution. So then you can see what the bottom result is to the financial aid. Now in this case, you may not be able to see in the back, but the cost of attendance is listed at $45,337. Then right below that in the little section where they list all the financial aid, that totals $41,400. That's not the full cost of it. There's a gap there. This student, they got gapped. There was a gap there. So that means that to fill that gap, the family's going to have to pull more money out of their pocket if really that cost of attendance is going to be accurate. So just because you get an award letter, just because a student gets an award, doesn't mean that the full cost of attendance will actually be met, all right? The colleges that really want a student, they're going to meet that full need. And then they may give more grants and scholarships versus loans. The students that barely get into an institution, the college is just going to give them pretty much straight loans, all right? It's packaging. You'll hear that term quite often. So you need to look at that award letter and look at the different elements, because some things are estimated. The MAP money is estimated. The Pell money is estimated. It's estimated because it's contingent on the funding being there. The MAP money, the Monetary Assistance Program, the Monetary Award Program in the state of Illinois, it's based on appropriation. How much money we get from Springfield, we being ISAC, how much money we get from Springfield, all that money that we get, we throw into grants and scholarships to students. So when they cut our budget at ISAC, they're cutting grants, okay? So that's why sometimes the MAP money may be a little less than what we initially expected. With the Pell, when they talk about the budget discussions and arguments in Congress, Pell is usually one of the items being discussed. So that could be an effect. Right now, the maximum award for Pell is $5,550, okay? But that also will depend on the expected family contribution of the family. The less amount that a family can contribute, the higher the Pell amount and MAP money will be. So some things will be estimated. And for scholarships and grants, you need to understand if it's a one-time deal or the information is it's renewable. Now, at the table back there, there's a form. It's something we created here at ISAC. And what we did is, this is a way, and even then, we try to simplify it. It still looks a little complicated. What we did is we tried to compare 3 colleges in a single form. And what you would do is you list 1 of 3 colleges on the top. Then you would list the cost of attendance for each institution. Because sometimes an institution may not list their whole cost of attendance. They may just list tuition and fees and room and board, and that's it. They may not list books and supplies, or they may not list transportation. So you list all of that, so you have a total cost of attendance, okay? Then you put in your expected family contribution, so then you can determine what is your financial need, just to make sure it matches up what's on the award letter itself. Then below, we talk about the different types of financial aid. The first section talks about federal grants, just like Paul mentioned how we first go federal, then state, and then institutional. So we list the federal grant, the Pell Grant. Now, does the school participate in the Federal Supplemental Education Opportunity Grant, the FSCOG? if they do, because not all colleges do, only about 1,700 colleges across the country participate, and we have over 4,000 or closer to 5,000 colleges across the country. All right, so not all of them participate. If they do, you write that amount there. Then the following line is about the monetary award program. That's the state grant. And then there's another thing for scholarships, because sometimes we have scholarships to the state for people going into like special ed, you know, or other very specific areas. So you write that down. Then we list college grants and scholarships and other grants and scholarships, and that's the total gift aid. And as I mentioned in my first part of it, gift aid is money does not have to be repaid as long as it's used for educational purposes, okay? Then after that, we list work study, okay? And work study is a campus job. And then we go into the loans, and I have a slide or two about the loans. So then you can see the total financial aid offer. So that's a way to kind of take those award letters, instead of putting them side by side, you can put them all in one form to be better able to grasp or picture what's being offered to you. And you can download this form from our website if you want, or take as many as you wish from back there. Federal work study is a program for which the student needs to fill out the FAFSA, because what happens is this is a campus job where 25% of the salary is being paid by the campus and 75% is being paid by the Department of Education. So for colleges, it's cheaper to hire work study students than to hire someone where they have to foot the whole hourly wage of the student. So that means if somebody gets work study, they're more likely, number one, to be employed. And then the other thing, number two, is that the money they earn for work study, that's a protected income that doesn't have to be used for the following year when they calculate the EFC. That's for the right there and then. And they also have a lot of perks about flexibility with hours, limited number of hours that you work, and then also the subjective factors of maybe the person with whom you're working could write a letter of recommendation for grad school, professional school, because usually students work in academic departments. So it has a lot of real perks, but you have to earn the money. You actually have to work, which means you have to get hired, and you can be fired depending on the type of worker the student is. But it's a great opportunity if they can do that. With the loans, you may be familiar with this slide already. You need to look at 4 components. What is the source of the loan? Who's offering the loan? Is it subsidized or unsubsidized? What's the interest rate? Obviously, just like buying a mortgage, you know, getting a mortgage, the lower the interest rate, the better. And then what are the repayment options and the grace period? Okay, because these will have to be paid back. Will have to be paid back. Loans are not dischargeable in bankruptcy. With very, very few exceptions will they be discharged. Basically, you have to either die, be permanently disabled, the school has to have false certification, or the school closed down. So you probably will not have a discharge. Now, when I mention subsidized and unsubsidized, as a refresher, a subsidized loan is a loan that's, first of all, it's need-based. So they'll give the subsidized loans first to students who have financial need. With subsidized loans, the interest is either paid by the federal government or the college while the student is at least half time in school, or in college, all right? Once they leave, then they're going to be, after the grace period, they're going to be responsible for the interest and the principal. But while they're still in college, while they're still enrolled more than half time, the interest is taken care of by the federal government or the college itself. An unsubsidized Stafford loan is one that's not based on need, which means the student is always responsible for the interest on this loan. But you say, well, why would I want to take an unsubsidized Stafford loan? Well, once a student graduates, there are some special programs that come into play either by the state or by the Department of Education, whether it's loan consolidation or income-based repayment programs, income contingent programs, loan forgiveness programs, where they say it has to be a direct loan, aka a Stafford loan. Okay, alternative loans that student got on their own would not count. So this is one good reason for that. And usually the interest rate on non-subsidized Stafford loans are typically lower than what you would find in an alternative loan. But to qualify or to be eligible for unsubsidized Stafford loan, a student has to do a FAFSA. But once again, it doesn't matter how much you make, you would be eligible for it as long as you are able to complete the FAFSA itself. This is a slide of example of a couple of different loans. We have the Perkins Loan, which is a campus-based program using federal funds, which is subsidized. The interest rate is 5%. They do put limits on these of $5,500 per year, and the grace period is 9 months after the student, drops below half time. With the Stafford loan, the subsidized right now is at 3.4%, and the unsubsidized is at 6.8%. Okay, there is a difference, but there is also limits as to how much could be taken out as subsidized and unsubsidized, but the grace period is 6 months. And then there's the Parent Plus loan, which is a loan that a parent takes out on behalf of the student, which means the parent will be responsible for paying that loan, okay? But it's credit-based. So if the parents don't have very good credit, well, they may not qualify for that. And they're tightening up the application process for that, so not all parents may qualify. But the interest rate is 7.9% and it is fixed, okay? What I'm getting at here, oh, and also the grace period within the first 60 days. Okay, so you have to start paying that earlier in regards to the loans themselves. But you could do something called capitalization, where you defer the interest on that loan until later time when the student leaves college. But what you need to understand, or not to understand, but what you need to be aware of is, okay, what kind of loan are they offering me? Was it subsidized or unsubsidized? So I know if I'm responsible for the interest right now or later, and what's the interest rate? So when you get that award letter, you can see the different types of loans, and you can say yes to this, no to this, yes to this, no to that. You can pick and choose which loans you want or do not want, okay? Because once again, that financial aid, which includes loans, is to meet the cost of attendance. All right. So if you think the cost of attendance could be a little bit lower, maybe you can get away with maybe rejecting the $500 unsubsidized student loan. So when you look at those award letters, in general, you need to consider the ratio of grants to loans. Okay, because as Paul mentioned, a family can have the same EFC, but the award letters from the same college could be very different based on in reality, the quality of the application of the student and also perhaps the major to which they're applying. A couple of other subjective factors. You need to look at to see what the self-help to grants, basically the loans. You need to look at the terms of the loans. Are they favorable or are they unfavorable? Is there a financial aid gap? Okay, that's a key one. Is there a gap there? And then also with the future packages, is this package that's being offered to me renewable? Or is this just a one-time deal? More often than not, more often than I would like, I should say, more often than I would like, I run into students who say, well, I got a really good deal my freshman year, but I can't afford to come back for my sophomore year because the same amount of money is not there as it was before. Students, when I meet with them, I tell them you need to extrapolate either for 4 years if you're going to four-year school or if you're going to doing a certificate or associate's program, whatever that 2-year program would be, extrapolate. Make sure you plan it out so you can understand what's going to happen. And with outside scholarships, each college may treat that differently, but for the most part, when you do get an outside scholarship, you're supposed to report it to the college, and the college may redo the award letter itself. Because in general, the award cannot really exceed the cost of attendance at an institution. People really are not going to pay you to go to college and then give you a little bit extra to go to college. It's there to meet the cost of attendance. And the college will require documentation to resolve any issues because it's their responsibility to resolve those because they are stewards of state and federal monies. We as a state, Department of Education, as the federal entity, will tell university, we're going to give you money on behalf of the student, but you are entrusted to award that money properly because if it's awarded improperly, there's an over-award. We're not going to ask the student for the money back. We're going to ask you, the institution, for the money back. So that's why colleges have all these rules. They'll ask for the documentation to make sure the ducks in a row and to avoid any over-award because they know they will have to pay that money back to the state or the federal government. And then also with the colleges, they also need to make sure the student is making satisfactory academic progress, which means they need to be on track to graduation. So that's why when they do the Fafsa every single year, we double check, are they making satisfactory academic progress? Are they on track for are they still enrolled? Are they on track for graduation? And offers will be void if false information is given or information is incorrect. The award may be redone. The package may be redone because these award letters that students will get typically in mid-April before that May 1 deadline are contingent on many factors. First of all, the funding be there for the state of Illinois and the Department of Education. Second of all, the information provided in the Fafsa was actually accurate. And then that's where the verification process comes into play because if some items are incorrect, they'll need to redo that. So when a student matriculates in late August or September, whenever it may be, then that's when the money is dispersed and then everything goes into play in the sense that student continues on with his or her classes. Because hopefully the financial aid process will be well taken care of before a student begins his or her classes. So that's a really quick synopsis in regards to the financial aid award letters. But the takeaway is we had these forms, sit down and compare and contrast. If there's an institution that you really want, the student really wants to attend, and they don't feel the award package or the award letter is not that favorable, go talk to the financial aid officer, the admissions folks, you know, especially at private institutions, because they may be able to do some things with that award letter. At public universities, you probably won't have that flexibility. You probably will not rework an award letter. The only time they would rework an award letter would be, as Paul mentioned, if there's some extraneous circumstances. Someone got laid off, their hours were cut at work, there's a medical situation where they're going to be hospitalized, you know, heaven forbid, you know, somebody got, you know, cancer or something like that, where there's going to be all kinds of bills. That's where communication with the financial aid office is key, so they understand the complete picture, so they can determine, okay, to whom do we give the money? Because we want to give the money to those that need it the most so they can actually enroll at our institution. Okay.